Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 34.12%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 21.18%. It's also beating the S&P 500 since the portfolio was started. But our best performing portfolio so far has been our technology portfolio, which is an annualized return of 42.8%. It has only been in existence since April of this year, so its return will likely fluctuate a lot, and it's very volatile so far. And like in last week's video, later in the video I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. On the next slide, I'll talk about how the market did last week and how our portfolios did as well. But what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,631 after 150 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stock each week. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well. As you can see, our portfolio had overall losses, where the blue line dips below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April of this year, like I said before, but has been the best performing portfolio over that time. But remember, it's very volatile because it's only tech stocks. And for those of you who have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our website, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting. I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goal and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,631. The portfolio's return has been 21.18% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio once again beat the market. Here's a look at our portfolio returns for last week versus several benchmarks. Tech stocks fared the worst, as you can see at the very bottom, where the technology ETF, ticker symbol XLK, fell 3.57%. Our tech stock portfolios naturally fell too, but less than XLK. The S&P 500 fell 2.08%, while our two dividend portfolios fared better. This is the power of dividend investing. During downturns, dividend stocks usually don't fall nearly as much as the market. So why did the market fall last week? According to the Center for Financial Research and Analysis, investors were unnerved by firmer readings in the consumer and producer price indexes, that's inflation, along with a no hurry to lower rates comment by Federal Reserve Chairman Powell, which implied that the Federal Reserve may skip a December rate cut and take a slower to lower interest rate reduction approach in 2025. In other words, the market's thinking rate cuts won't be quite as many as people were hoping. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August 2023, and the annualized return so far is 34.12%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 23.1% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, beatthestockmarket.com, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for nearly 15 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return, which has existed for a much longer time period. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 54% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested into Dividend-Growers. Now, a dividend grower is a company that increases their dividend. And Dividend Initiators, that's a company that initiates or starts a dividend, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, the S&P 500 includes both dividend payers and non-dividend payers, so a better comparison is just comparing it to non-dividend payers. So that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail in dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield now, based on the original investment, is 8.21%, and that's only 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we've constructed a diversified portfolio. Now in December, Broadcom is going to release their latest quarterly earnings, and I'm hoping and expecting them to increase the dividend again. We'll see. So this is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about, but over the years, Home Depot has grown the dividend to the point where the yield now, based on the original investment, is 31.1%. And, like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. And within the last month, these numbers were increased. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies on my own, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my current brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation every year. By the way, I also invest in these same stocks in my retirement account and taxable brokerage accounts. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For a Classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. Now that year, the inflation was high. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend-growth stock portfolio's annual return is 21.18%. If we instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 12.38%, a difference of 71%. Our high-yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying Classroom stock portfolios. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps, and that's not a good thing. So I really don't trust their algorithm. This slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right, the dividend-growth stock portfolio was started much earlier than the other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend-growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, none of that portfolio stocks have made this list yet. However, just missing the list at number 16 is Shopify, whose stock shot up 24.5% last week, giving the stock an overall gain of 85.2% in a little over a year. Shopify is in our tech stock portfolio. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio. But it has only 1 stock on the list so far because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks in our dividend growth portfolio, probably about a quarter of the number of stocks in our dividend growth portfolio. Stocks in yellow, meaning Evercore, F&G, Annuities, Repositrac, and Tapestry, have been sold. Our best performing stock so far has been Evercore, which was sold recently. It provided us with a 252.9% total return in a little over 2 years. Broadcom, a chip maker, remains at number 2 with a 197.6% total return since its initial purchase. Nvidia is number 3. The fastest risers that are still in the portfolio are our Nvidia in our tech themed portfolio with a total return of 194.9% in 10 months, and Bank of New York Mellon with a 91.4% gain in 13 months. And remember that total return includes both the dividends the companies paid as well as the increase in the stock price. So this slide shows our best performing stocks last week. Despite the market pullback last week, we had a couple of very good performers, most notably Shopify with a 24.5% gain last week, and Charles Schwab with a 9.1% gain last week. And this slide does not include dividends. Before we look at the 10 stocks we bought this week for our dividend growth portfolio, here are the dividend-paying stocks we bought a year ago along with their total returns, which of course includes dividends. Stocks in yellow have been sold. On the left are the 10 dividend growth stocks we bought a year ago. Stocks in yellow, like I said, have been sold. In other words, we sold Best Buy, Norfolk Southern, and Elevance Health. Stocks, American Express has been the best performer so far with an 86.8% return in a year. The average return of the 10 dividend growth stocks we bought a year ago is 38.49%, with 3 stocks being sold and held, and therefore held less than a year. The annualized return of all 10 is 44.53%. On the right side of the slide are the 8 purchases we made for the high yield stock portfolio. Now that portfolio utilizes two different strategies, and the strategies often overlap, meaning we often make two purchases of the same stock. As you can see, we bought Best Buy for each strategy. The average return of the high yield stock purchases we bought a year ago is 40%, despite 6 of the purchases not being held the full year. The annualized return for all high yield purchases is 68.51%. Obviously, our purchases will not continue that higher rate of return, but it's a great start for the portfolio. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. On Monday, we sold Albemarle for our dividend growth stock portfolio, and we sold Tapestry for our high yield portfolio. Despite Albemarle's approximate 9% rise on Monday, we sold Albemarle for a loss of 8% on our single purchase of the stock. So fortunately, we only bought it once for the dividend growth portfolio. The stock was held 265 days. We sold because we believe electric vehicle demand will likely fall short of Wall Street's lofty expectations over the next 2 years. I'm kind of glad to get rid of it too, because it's a very volatile stock. We sold Tapestry last Monday for our high yield stock portfolio. The luxury goods maker provided the high yield portfolio with a total return of 92.05% in less than 13 months. While it still appears to be fairly valued, the stock's 4-way rating of valuation, quality, past dividend growth, and potential for future dividend growth is now in the bottom 27% of stocks, so it limits its upside potential. So we thought it was a good idea to sell it and reinvest in other stocks that have higher upside potential. Now let's talk about the dividend growth stocks we bought last Monday for our dividend growth stock portfolio. Here are the ratings for our top 15 dividend paying stocks this past week, but remember, we only buy 10 per week. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow have already grown to be 4% or more of the portfolio, so we do not invest more in them this week or last week because we want to build a more diversified, less risky portfolio. Bristol-Myers was back again last week at the #1 spot. MasterCard did not make it this week, or I should say last week, as its margin of safety wasn't quite large enough. Remember, we use many criteria to filter stocks, and if they are hovering at the required level, like MasterCard was, they can make the list 1 week and then drop off the next week based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes very frequently. Visa was still on the list, and like Allegion, both stocks have a 4% or greater allocation in the portfolio, so I wasn't supposed to buy more of them. However, I made an error, and I included Visa as one of the stocks that I bought on Monday. Oops. So again, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature. But I think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. So this table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Huntington Ingalls, Nike, which raises dividend on Thursday, Cigna, and Qualcomm. Remember, all of these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. It's not looking for just stocks that pay a high yield. You don't want to invest in only stocks with really high yields because usually those do not grow, and sometimes they get cut because they're too high. Now, the stocks with the highest yields were, in order, Bristol-Myers, PNC Financial, Huntington Ingalls, and Nike. And the Nike yield was before they raised their dividend later in the week. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks in the next few slides. This week, I purchased over $3,100 of the stocks from the dividend growth portfolio, high yield portfolio, and the tech portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other stocks so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, on average. But studies have shown they historically beat the market averages by a significant amount. We did not buy any under the radar dividend payers last week, but I will likely buy one on Monday. All of the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to shareholders. So risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Now, if you're looking for lower risk stocks, I would suggest looking at Microsoft, Nike, West Pharmaceuticals, and Yum Brands. Now, a lot of people who are living off their dividends will only invest in stocks with a below average risk rating because they're afraid of dividend cuts. Well, the advantage of having such a diversified portfolio that, like we do, is you can invest in some above average and even high-risk stocks because you're so well diversified. For example, Applied Materials is above average risk, and so is Qualcomm. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials, Thermo Fisher, Microsoft, and Visa. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Bristol-Myers, Huntington Ingalls, and PNC Financial. All of these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works usually. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Bristol-Myers, Applied Materials, Thermo Fisher, and West Pharmaceuticals. These earned an A- or better grade. Companies with the best combination of recent dividend increases, good dividend yield, and potential of future dividend increases are Bristol-Myers, Applied Materials, and Thermo Fisher, having earned an A or B grade for both categories. Here are our trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that we had recently received, plus proceeds from the sale of Albemarle, which we sold, as you can see, in green at the bottom, and then invested the total in the top 10 stocks on our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. Now, one note, Visa comprised 4% of the portfolio, so I should have skipped purchasing it last Monday, but it slipped my mind and I ended up buying it again. Oops. Sometimes instead of dividing evenly across all 10 stocks, I try to invest a bit more into the higher ranked stocks, but this week, or I should say last week, I split up the investments as evenly as I could. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up portfolio diversification, I believe there are 4 potential ways to boost a portfolio's returns. Now remember, our portfolio currently has about 199 or 100 stocks, so you could safely reduce its diversification. So each week, we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or you could do like 1 through 6, 1 through 7, etc. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only the stocks ranked 1 through 5 would have improved annual returns 55.7%. But I personally prefer a more diversified portfolio, since the goal of my dividend portfolio is to live off the dividends. So option 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Now normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very well diversified, because the ultimate goal of dividend investing is to have the dividends cover all of your expenses plus generate extra income for vacations, travel, etc. Now, I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost a portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point number 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 26.6%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers in the portfolio, despite having some incredible performers like F&G annuities, 119% gain in 12 months, and Repositrax, 97% gain in the same time frame, on average, they have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well so far as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could potentially sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell very often in the dividend growth portfolio, and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in the stocks, or in that week's 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I would be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to have your own valuation methodology. But sometimes people use really simple one metric methodologies for valuation, such as PE ratio. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there is no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of the paycheck, which is usually every other week, and it's automatically invested in their 401k. Now, when I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more stock diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at stocks that have raised their dividends recently. Now, the holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, meaning one that increases each year above the rate of inflation. Now, last week, Nike raised its dividend by 8.1%, and EOG Resources boosted their dividend by 7.1%. The last 22 dividend increases for the portfolio have an average increase of 10.8%. Now let's talk about stock splits. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. So I have to remember to go back and adjust Entergy Corp's metrics because they will split their stock 2-for-1 on December 13th. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Visa remains at the number 1 spot, and Microsoft moves up a spot despite tech stocks having a very bad week. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But like I've said before, I'm a conservative investor. Therefore, we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we had always invested in our top 10 stocks, regardless of the size of the stock portfolios or the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now, our portfolio holdings so far are 99. So far, around 100 seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. I believe our holdings got up to 103 at the most at one point. Now, that might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. Now, the thing that did take a lot of time and a lot of hard work was creating the spreadsheet. It took about 2 years to finish it. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields, and they've asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in their dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return of 34.12% per year. Since the portfolio has been in existence for nearly 15 months, that return will likely fluctuate a lot more than the return for our dividend growth portfolio, which has existed for 34 months. Currently, the high yield portfolio's dividend yield is 4.16%, but the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be geared more towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amounts we have invested to 5.06%. 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds. In other words, high yield and dividend growth. So it's a greedier strategy, if you want to call it that. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 20.87% and has been held for an average of 186.7 days so far, which is an annualized rate of 44.88% using Excel's rate function. Now, it's obviously not likely that the portfolio can keep up an annual return that high since stocks historically averaged about 9 or 10% per year. On this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. As I mentioned before, strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2, like Bristol-Myers did last week. If that's the case, instead of the stock getting a 1/8 weighting, they get 2 eighths, which is equivalent to 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality ranking of B- or better. The 4 high-yield stocks we bought last week while implementing strategy 1 are Bristol-Myers, CVS Health, LyondellBasell, and UPS. And the 4 high-yield stocks we bought last week while implementing strategy 2 are Bristol-Myers, PNC Financial, United Parcel Service, UPS, and Lyondell again. This week's purchases have an average, or I should say last week's purchases have an average yield of 4.9%, with Lyondell coming in the highest with a 6.3% dividend yield. Here is a look at Monday's ratings for competitive advantages, management, and financial health. Of course, that's last Monday. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high-yield stock portfolio. We took the weekly deposit plus the proceeds from the sale of Tapestry, as you can see in green, plus any dividends that had recently been received in our account, and then invested them in the top 8 stocks on our buy list for the week. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into stocks offering products or themes involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment and seeing how high we can grow it. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector, not the technology sector. So far, the portfolio has gained 33.5% in a little over 10 months. In comparison, technology ETF with the ticker symbol XLK is up 19.4% over the same time period, and the S&P 500 is up 24.4%. Best performers so far are NVIDIA at 194.9%, Fortinet, Meta Platforms, SAP, Broadcom, ServiceNow, and Pure Storage. And back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, but it's been fun to follow despite the volatility. since this portfolio started, it has outperformed the two dividend portfolios over the same time period. Tech stocks got crushed 2 weeks ago, did fantastic the next week as the portfolio jumped 6.2% in that week alone. And then last week, the portfolio fell 1.8%. So very volatile. And this once again showing the advantage of lower volatility strategies such as dividend investing for those that can't stomach such large swings up and down. So how is this portfolio different from the $1,000 tech portfolio shown on our previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in this technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 98.5 days and has produced an average total return of 10.09%. Using Excel's rate function, that's a 42.83% annualized return. If we'd instead invested our weekly investment into XLK, instead of a 10.09% average return, we'd get an average return of 4.02% over the same time period. Annualized, that's 15.75% per year. The portfolio is also outperforming the S&P 500, but remember the volatility is very high, so it's not for the faint of heart. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use a valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. The top 4 technology stocks last week, according to our rankings, were Adobe, ASML, NICE, and Microsoft. And notice number 9, we bought Shopify, and then last week it jumped over 20%. So in the comments, let me know if you have any questions. And also let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on our website, beatthestockmarket.com, with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about our portfolio holdings. I'll see you again next week with a list of stocks we'll have purchased on Monday. See ya.